Welcome to Get Rich Education. I'm your host, Keith Weinhold. The economy is booming. United States GDP is up. The homeownership rate falls again, and we're seeing credit score inflation. If you like the flexibility of home equity lines of credit, consider if your property's entire mortgage, your first lien, operated like a HELOC. Yes, you can do that now, today on Get Rich Education. MC Lobsher is the host of the Cash Flow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com.
Learn the easiest way to create wealth and passive income with real estate. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those investment properties. Narada Real Estate saves you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more at PassiveRealEstateInvesting.com and download your free copy of the ultimate guide to passive real estate investing. There's no obligation and nothing to buy. Simply visit PassiveRealEstateInvesting.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to Get Rich Education. I'm your host, Keith Weinhold. Let's talk about some real estate and economic trends that affect you before we discuss first lien home equity lines of credit. GDP is the broadest measure of goods and services produced in the U.S. economy, and it climbed at an annualized rate of 3.2% in the first quarter of this year. That is way better than economists expected, and it's the strongest growth rate in almost 4 years. Now, that's skewed somewhat with how they calculate the number and what's going on with imports, but still, GDP growth has accelerated nearly every quarter for the last 3 years, and that, fueled with the fact that a few months ago, the Fed backed off from their rate-raising stance, that has created a ton of optimism in financial markets, and that includes the real estate market, but we do still have a falling home ownership rate. So let's dig into this. What's that really mean? Why do we look at home ownership rate if we are investment property investors? Well, a rising home ownership rate, that primarily reflects younger households successfully making the transition from renting to owning. That's the crux of what that means. Well, why? What is the reason for the falling home ownership rate? Well, for starters, the median age for a first marriage is now up to 30 years old. Yes, we've reached the point where that age has fully hit 30. Some of our human ancestors had a life expectancy of 30. People used to die at that age. Now they get married at that age of 30. Your chances of owning a home are more than 10% greater if your parents owned a home. That's a somewhat interesting finding from the Urban Institute. So the homeownership rate is falling again. 15 years ago, it hit its recent peak of 69%, and it is dramatically lower today. Now, it actually did tick up just slightly the past 2 years, but that's inside this longer-term trend of it being dramatically lower over the last couple decades. From Q4 of last year to the first quarter of this year, the homeownership rate ticked down from 65% to 64%. Now, it's not just delayed marriage that contributes to low homeownership. We've talked before about how high student loan debt payments prevent millennials from forming the necessary down payment to get into a house. With the low homeownership rate from about 69% back in 2005 to 64% today, that means there are more renters since there are fewer owners. Well, that's good for income property owners like us, more renters. Lower homeownership has occurred despite the fact that there is a credit score inflation affecting the market. Now, Market Watch was reporting on this. You've heard of grade inflation, right? That's the theory that as teachers have handed out more and more A's over the years, the grade just does not mean what it used to. It's been diluted. Well, now some analysts are worried about what they're calling credit score inflation. In fact, according to Moody's, there are about 15 million more people with a FICO score above 740 today than there were before the Great Recession. Now, of course, Moody's didn't appear to report that in percentage terms. You've got to consider that, of course, there are also more Americans than there were before the Great Recession because our population rises. But in any case, proportionally, there even appear to be more people with FICOs above 740 than there were then. So there has been this inflationary effect in credit scores. A 740 FICO score is what's considered very good. Borrowers who score that high typically qualify for the better terms from lenders. You're going to get a lower interest rate. At last check, I believe, 740 was the top score that gives you the best conventional mortgage rates. And if you have a score higher than 740, like a 768 or a 795, well, then it doesn't matter. It does not make your interest rate any lower or your terms any better. So how big is this credit score inflation? The average FICO score is now a record 704, and you might recall that 850 is the highest score possible on that scale. So this 704, it's about 20 points higher than just a decade ago. That's the inflation. Yes, the 704 average is indeed a record. And remember, there were changes made to the FICO scoring model itself a few years ago that enhanced the median score. And now, with unemployment low and wages rising, it makes sense that people are in better shape these days and that scores have inflated. People have less debt and they have fewer instances of delinquencies or other blemishes on their file. And that sort of underlying improvement in financial health is really what's driving the improved credit scores. The chief economist at Moody's says that the strong economy might be masking some risk, especially at the lower end of the credit scale. If you had a low score of 600 back in 2009, well, that might have just been a symptom of the external economic environment, because back then, unemployment was high, foreclosures were rising. But a 600 today, when jobs are plentiful and wages are rising, that might indicate some higher risk than it would have back in 2009. Inflated scores, that would really be less concerning if lenders just did not put so much weight on these credit scores. A credit score is not some sort of magical shield that says this person's never going to default. If you have a high credit score but something bad happens to you, you are still likely to have problems paying your bills. And, even the companies that sell credit scores say lenders should consider a bunch of other factors when judging a person's creditworthiness, including a person's income and debts, and probably even the state of the economy. I think too much weight is put on a person's credit score and not enough on their income when they're going to qualify for a property or something else. Even though a borrower's income is already important, I think it should be stressed even more. The credit score is just not an absolute metric. It's a relative measure of a consumer's risk level compared to the broader population's level of risk. And for now, that broader risk remains pretty low. The bottom line is that credit scores are higher now, and that means more people are eligible to borrow, and that in turn makes for a greater buyer pool, and that greater buyer pool leads to greater demand, and then that greater demand can lead to higher real estate prices or higher prices of other assets. Credit score inflation then can lead to asset inflation and monetary inflation. There's a new loan product that operates similarly to a first lien home equity line of credit. That's something that you're definitely going to want to know a lot more about. In fact, this is probably the most excited I've been about a new real estate loan product in quite a long time. I'm fortunate really to be one of the first outlets and people that talks about it here anywhere in the United States. We're going to discuss the details right after this. You're listening to Get Rich Education. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Caeli Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is David Campbell from Hassle-Free Cash Flow Investing. Listen to Get Rich Education with Keith Weinhold, and don't quit your daydream.
I'd like to welcome back onto the show a familiar guest because she's the president of Ridge Lending Group. They're the company that's created more financial freedom through real estate for others than any other company in the entire nation. Welcome back onto Get Rich Education, Caeli Ridge.
Thank you, Keith. I'm always so excited to be here joining you and your listeners.
I'm excited too because we're usually here to talk about income property loans, but you have an innovative mortgage product that one can use for either their own home, their primary residence, or for income property. So tell us about this instrument that basically acts as a first lien HELOC.
I'm so excited about this. It is the first time in many, many years that we've had the availability to look at a HELOC in first or second lien position for investment properties. It has been available for an owner-occupied over the last 5-ish years or so, but I think that even more special now that we have access to it for our investment properties, I think people are really going to find some huge benefit here. But in quick terms, what we're talking about is we call this our Home Select loan. This is a line of credit. It provides financing for up to 30 years. It takes first lien position over all other loans on the property. It's much like a credit card, actually. I know that sounds kind of funny, but the line of credit represents the maximum borrowing amount of up to 80% on a primary residence, 70 to 75% loan to value on investment properties, depending on the property type, for qualified borrowers. The line of credit maximum remains the same for the first 10 years of that 30-year term, and then it will reduce by 1/240th per month throughout the subsequent 20-year repayment period. So as an example, if you started with a line of credit limit of $100,000, in month 1 of year 11, amount would reduce by 1/240th. So instead of having a $100,000 line of credit amount, you now have $99,000. What's the math? 840, 800, and I can't do mental math. I'm in finance. But you get my point. Yeah.
Yeah, it is kind of interesting. Home equity lines of credit and this product that you're talking about, the Home Select loan, they both work sort of like credit cards. They're elastic, they're flexible, but these come with substantially lower interest rates. And these also come with interest that may be tax deductible. But okay, sort of said in another way about the way this Home Select loan works is a borrower must not begin making any principal payments until the end of year 10.
They don't need to.
They could, but they don't need to. They have that flexibility. But after year 10, they must begin making principal payments. You can make interest-only payments for the first 10 years.
Correct. So the reduction of the line limit is what will start reducing as the principal. If it stays right as where it started, the line amount will simply reduce by that amount. And you're right, that's when the mandatory principal reduction takes place.
So this sounds like a great flexible product, this Home Select loan. Then that makes some people wonder, is this new and is this too good to be true? So tell us why this hasn't been offered to the public before. I think it actually has been, but just in other places. Tell us about that.
Yeah, and we've seen it. There have been smaller institutions that have launched similar product types. The mortgage products we use primarily today were actually developed, believe it or not, during the Great Depression era. Right? It's kind of funny to hear that. At the time, it lengthened the repayment terms for borrowers in an effort to making housing more affordable. Since then, there's been no substantial lobby, as far as I know, for change. And unfortunately, conventional loan products haven't kept up with the consumer demand and behavioral changes. In time, I think that the mainstream will start to come online, but for now, I think that this is a great first step.
Similar products have been in use for years around Western Europe, Australia, New Zealand, and elsewhere. But in the United States, really a lot of business loan products have operated just like this Home Select loan, and they are called things in the business world like universal accounts or ZBAs, zero balance accounts. So they have been around in a few different ways. And with those 30-year and 15-year fixed amortizing loan products born in the 1930s, the residential world has just really been slow to change. When we make a payment, we're not so interested maybe in paying down principal because we want to get the home paid off. That's what I discussed 2 weeks ago. But still, we'd all rather have our dollar go into principal than interest if it's going to be one or the other. Now, with a 30-year fixed amortizing loan, you're about 22 years into it until you're just halfway down on your principal pay down. That's something to keep in mind. With this product, you could have it paid off in 7 to 10 years. And yes, this is interesting timing with that show because about 2 weeks ago, I talked about how when you have a mortgage paid off, well, you can use that money elsewhere. So whenever I say paid off, just think about the fact that, okay, you have an opportunity to borrow against more equity in your home if you choose to do so. So you'd rather have each dollar monthly go toward principal rather than interest, and then you can borrow against that equity, that accumulated principal, instead of it going away to interest.
That's a perfect point, actually, if I can just segue in there, Keith. So what we're talking about for your listeners is the difference between a closed-ended mortgage and an open-ended mortgage, which is what the Home Select is. It's an open-ended mortgage that allows that flexibility so that they're not just closed into these regular predetermined payments, and at the end, that's it, it's done, you've paid all this interest. They have that flexibility and the choice in which to choose how quickly they want to accelerate the payoff, and then the ability to continue to have access to that equity at their disposal, I think, is the key.
It's about flexibility and liquidity. With either a conventional loan or a Home Select, when you pay interest, that money is gone either way. So really the key differences are that more dollars go toward principal with the Home Select rather than interest. And then secondly, you maintain liquidity of your principal. With a conventional loan, you don't, because when you go ahead and pay down principal, that money is illiquid. And with a Home Select, when you pay principal, your equity remains liquid.
Exactly right. Beautifully put.
How many years can a borrower draw from their Home Select loan line of credit?
Borrowers can draw funds from the line of credit for a total of 30 years, as long as their principal loan balance does not exceed their credit limit.
Got it. Is there any sort of balloon payment due with this?
There is not ever any balloon associated with the Home Select.
Okay, so with the Home Select loan product, how is a principal payment actually made? Can you give us an example?
Yeah, good question. So every time funds are deposited into the Home Select loan, a principal payment is made, meaning the loan balance reduces by the same amount the day of the deposit. Effectively, deposited funds help borrowers save loan interest at the same rate as the Home Select loan. Let me give you an example. If the interest rate is 4% and the borrower deposits their $5,000 a month paycheck into their Home Select loan, let's say that the principal balance on this loan is $200,000, the balance would then lower to $195,000. Those dollars are now saving the borrower loan interest at a rate of 4% by lowering the balance versus earning 0% in their regular checking account. Make sense?
Got it. That does make sense. You're not paying that opportunity cost of having the money parked in your bank account earning 0 or 1%. Instead, it could be in your Home Select product, even if it's for a short period of time, and then you're not paying that interest rate against your home for whatever period of time that you happen to have that money in there as principal, as short term as it might be. I want to ask you more about interest rates in a moment, but while we're on this, tell me how monthly interest payments are calculated.
Each night at midnight, the principal loan balance is multiplied by the fully indexed interest rate. Like you said, we'll come back to what that means in a second. And then that's divided by the days in the year, 365.
Yeah.
This provides a daily interest fee. Monthly interest payments are calculated by totaling each day's interest once the month has ended. And back to that flexibility theme, And that can be the point for certain people, having the ability to pay those extra payments at their discretion. They can do that on a closed-end mortgage, but without the flexibility piece. Idle dollars not yet needed for other expenses, I believe, are better utilized in the Home Select loan as they help lower the cost of monthly interest, but yet, of course, remain accessible to the borrower.
Yeah, you're really emphasizing that liquidity component here that you don't get with that fixed amortizing loan. What do you think about a borrower taking idle funds that they don't know what to do with, maybe that they've even had in an emergency fund, and just parking it in their Home Select loan for a little while until they know what to do with those dollars?
I think that most would agree. It's never completely recommended to put every dollar into just one financial instrument. However, I think that the Home Select leverages those dollars normally flowing through a checking account prior to them being spent in a unique way. If you consider how much money passes through your accounts, you can begin to see how the Home Select can rapidly reduce the loan principal without forcing any change to lifestyle or budget while saving on interest.
Yes, we have this great elasticity with this loan. We can borrow against it, we can pay it back or not pay it back or overpay it back to pay down more of that principal if we want to. Tell us more about why the Home Select loan is so effective at a borrower not losing dollars to interest.
And I'll give you some examples here too. It's a good question.
Yeah.
So because it works like a checking account, cash flow positive borrowers save in 4 ways. First, regular deposits, such as income or the short-term savings that we touched on, will drive down the Home Select loan principal dollar per dollar. Second, most of us don't spend all of our money on living expenses on the same day. Instead, much of what we deposit in cash remains idle while waiting to be spent in the coming days, sometimes weeks. So while cash sits and waits to be spent in the Home Select, it keeps the loan balance lower for longer. Interest is calculated nightly, remember, on the lower loan principal balance, which results into the daily interest, which of course will be less. The third way, the money normally budgeted for traditional monthly mortgage payment, let's say it was $1,000 a month, no longer needs to be spent, quote unquote. Those dollars are automatically used to keep the Home Select balance even lower. And then finally, extra cash that simply wasn't used as a part of the borrower's regular budget also remains in the account, helping to keep the balance lower for even longer. The lower principal balance, along with the interest saved, rolls over into each new month as a lower starting loan balance, which has a compounding effect on interest savings.
I sort of think as a conventional fixed amortizing product as a one-way loan. You, the borrower, make the payment, and then it's difficult to go back against that one way and get that principal back out. With the Home Select, it's a two-way. You have this flexibility and this fluidity of principal from you to the bank, if you will, and then from the bank back to you, 2 ways rather than one. Let's talk about interest rates. What is the Home Select loan's interest rate like?
So this is a variable, right? It's based on, so a lot of people are familiar with the term ARM, adjustable rate mortgage, and I think we'll get more into this in a second, but in quick terms for this answer, the Home Select is a fully indexed interest rate based off of the 1-month LIBOR. LIBOR stands for London Interbank Offered Rate, plus a margin of between 3.2 and 3.75 occupancy dependent. By occupancy, we're talking about owner-occupied versus non-owner-occupied or the rental. The margin is the fixed portion of the adjustable. So the index is the variable, the LIBOR, 1-month LIBOR, and then the margin, 3.25 to 3.75, would be the fixed portion of the interest rate.
Okay, so once the borrower is locked, the LIBOR can and will move around, but the margin on top of that does not. The margins are fixed once you're locked in. Now, ARMs, adjustable rate mortgages, give some people pause about that being riskier than a fixed rate mortgage. Talk to us about that.
This is a common misconception that really depends on the borrower's financing resources, behavior, and of course, goals. Adjustable rates like the 1-month LIBOR index, for example, can move up or down, but the reality is its value has less impact on the loan's interest cost than the amount being borrowed and the length of time it's being borrowed for. So put simply, the longer a borrower remains in debt, of course, the more costly the debt becomes, regardless of how low the interest rate. Here's a great example. I think your borrowers will resonate with this.
Yeah.
Let's say that we've got a $400,000 mortgage on a 15-year fixed loan at 7% interest. And let's compare that to the same $400,000 mortgage on a 30-year fixed loan at 4% interest. I think people listening to this are going to be shocked to learn that the 7% 15-year fixed mortgage is less expensive by $40,000 when you look at the big amortization. This is the entire principle of the Home Select loan. For this reason, borrowers no longer need to worry about the changing of interest rates, and they'll spend more time benefiting from a loan that focuses on lowering the balance faster.
Now, LIBOR, again, LIBOR, that index, LIBOR index, is a mystery to some people. Tell us some more about that and how it's used.
So LIBOR as an index, and I should start by saying that there are hundreds of indices used around the globe by lenders, but it was in 1984 that it became apparent that an increasing number of banks were trading actively in a variety of relatively new market instruments. And bankers worried that future growth would be inhibited unless a measure of uniformity was introduced. Officially adopted then in 1986, the London Interbank Offered Rate, LIBOR, index became the standard benchmark rate among the world's leading banks and is now regulated by the Intercontinental Exchange, ICE. LIBOR rates are calculated for 10 different currencies and borrowing periods ranging from overnight to 1 year, and are published daily at 11:30 a.m. London time by Thomson Reuters. Today, more than $350 trillion in financial products are tied to the LIBOR, including our Home Select product.
Now, I know everyone's on the Thomson Reuters website at 11:30 a.m. London time every day checking the rates, but just so you know, I did check shortly before our chat, and the 1-year LIBOR currently is at about 2.5%. So just to give you an idea of what your interest rate would be, and remember, it would float because the LIBOR floats with this product is 2.5% plus about 3.5% in that margin that we discussed earlier, 3.5% plus or minus. So right now, your interest rate would be about 6% with this Home Select product today.
Yes. Maybe it's helpful to hear some historical averages of the 1-month LIBOR. So since 1986, if we go back to its inception, the 1-month LIBOR average has been roughly 4%, while in comparison, let's use Freddie's 30-year fixed has averaged at about 7%.
Okay, so looking at the long-term average, if you take the LIBOR at 4% there, add a margin of about 3.5% to it, then historically, long-term, you'd be looking at about a 7.5% interest rate. Talk to us about the relationship between the 1-month LIBOR and rates that are used here in the United States, just so our listeners have some sense of the LIBOR's movement and just how high or low it can go.
Yeah, that's a very good question, and there absolutely is a direct relationship between the two. The 1-month LIBOR tends to move evenly with the Fed funds rate, which should be familiar to most of our listeners here. The overnight rate, the Fed fund rate specifically, is the overnight rate used by banks in the U.S. to borrow from one another. I think that this is largely considered as LIBOR's cousin, let's say, because the 1-month LIBOR and the Fed fund rates are the most influential in the world. These two indices move methodically in value, consistent with the global and economic environment. The Federal Open Market Committee within the Federal Reserve System, the Fed, is charged by U.S. law with overseeing the nation's open market operations and may impact the Fed funds rate either by changing the capital reserve requirement policies for the nation's banks or by changing the target rate by which banks use as a benchmark for lending to one another. So you can see that they're very closely related.
We're talking about the Home Select loan, which operates much like a home equity line of credit with Ridge Lending Group owner Caeli Ridge. Caeli, are there limits to how much the Home Select loan interest rate can adjust? Are there caps or are there floors?
Yeah, absolutely. There are caps associated at how this will move. The Home Select loan comes with a lifetime floor. This is going to generally be set at or near the fully indexed rate. So earlier you were talking about the index and the margin. When those two factors are added together, that will generally be the floor rate. On occasion, the floor rate could be as low as the margin, the starting margin. And in our case, it could be between 3.25 and 3.75. So there is a lifetime floor, which means that the interest rate cannot go below that. And then the lifetime cap is set at 6% over the greater of the floor, whether that be the starting margin or the fully indexed. So let's just give another example. Let's say that the fully indexed rate, you start at 6%. The lifetime cap set at 6% over that would give it a life cap of 12.
Got it. Okay. And since this is a flexible product, maybe if a borrower saw rates go that high, then they would want to focus on more principal pay down, or maybe they still wouldn't, just depending upon their outlook and strategy. Let's talk about borrower suitability. Who is this for?
Yeah, this is one of my favorite questions because I think that it's important to educate people that it's not going to be for everybody. Borrowers with great repayment history, positive monthly cash flow, and low debt to income ratio make great candidates for the Home Select. To measure a borrower's ability to repay the loan, guidelines on our end take a very conservative approach and require the payment used to qualify is based on an interest rate 2% over the fully indexed rate. And that's just for qualifying purposes. And then we take it and amortize it over a 30-year period of time by the loan amount that's being secured to test short and long-term financial benefit. The real test is done, though, by running the Home Select Interactive Simulator. Users are prompted to enter incoming net deposits and outgoing debt payments and regular expenses, and in a matter of moments, literally can view and compare the potential savings. If the Home Select isn't suitable for an individual, the simulator will make that clear. But in general terms, I would say that individuals that have at least a 10% buffer or residual income on a monthly basis after all expenses are paid are great candidates.
There is an interactive simulator that you, the prospective borrower, can use, and you can go ahead and enter your existing loan terms and then your proposed loan terms with this Home Select product and see how it would help you out. So with that in mind, Caeli, what really is, just summing it up, the primary benefit of the Home Select loan again, just to get people caught up in case they're unclear?
I would say that it is flexibility for me. And looking at this from my own perspective and as a fellow real estate investor, the flexibility is really what I admire most about it. Now, clearly, reducing an interest payments that you'd be making, a huge reduction there is a huge advantage. But I think the flexibility is what most investors are going to find most useful here.
Yeah. Saving mortgage interest could negatively impact a borrower's taxes, of course, but again, we don't want to let the tax tail wag the dog. You would not spend $1 in interest just to maybe get 25 cents back in taxes, but of course, consult your CPA about that. I'm sure this is a product that has a lot of people excited, but it might not necessarily be for anybody. You know yourself better than anyone else. And if you just go ahead and borrow against the value of your home to profligately consume, then this product isn't for you. So you just have any other thoughts about risk, especially pertaining to suitability, Caeli?
Yeah, I would say that in addition to maybe what I've already commented on, the borrowers that have expenses that are nearly equal to their income are going to be the least suitable for this loan product, the Home Select. And those individuals are potential candidates for other mortgage products. But like I said, a small residual, even at a 5% residual of income beyond expenses, this program works well. But we kind of set the benchmark at 10% residual income to expenses on a month-by-month basis is what the suitability barometer is.
That's a great way to put it. You're going to want some significant residual income in your life. Now, what if someone does spend up to the credit limit here with the Home Select loan?
Well, if you withdraw funds and your balance reaches your credit limit, you have no more available credit and you'll not be able to withdraw additional funds until you make a deposit. It's very, very similar to your checking account. Checks written will not clear after they reach the credit limit and may be returned due to insufficient funds. Again, just like a regular checking account.
All right. And then let's go to the opposite end of the spectrum, not one overspending on a round-the-world cruise or, maybe hopefully using that principal instead from their home to purchase income properties. But on the other end of the spectrum is what if someone does get the Home Select loan paid off? Tell us about how that looks.
That's fantastic. In many cases, exactly what the Home Select was designed to do, pay off early. If that's accomplished before the 30 year, you'll retain access to the home equity dollars without refinancing, which might be a good point to make here. The cost of refinancing can be expensive. This might mitigate a lot of those costs, futuristic costs, because you now have access to this line of credit for 30 years that you can continue to draw on without having to tap back into the equity via a full cash out refinance.
And again, I know to hear the phrase pay off early is a desirable thing might be a surprising thing for you to hear after our show 2 weeks ago, but just think of that can alternatively mean that when you have something paid off, you now have the ability to borrow against that entire amount should you choose to do so. But yeah, Caeli, you bring up a great point. With this product, you don't need to do refis along the way.
Exactly. And I think that in our case, that flexibility piece that we keep relating to is really what I find the biggest value here. You've got the flexibility to pay off as quickly as you want or as slowly as you want, interest-only payments if you want. But as you continue to utilize this vehicle in whatever manner best suits the big picture goal, it's open and available to you for 30 years. So I think that it's hugely attractive to what investors are going to be finding out there in the open market. And as it's the first one I know of for investment properties, I think the program is going to do very, very good things for investors.
Lastly, is there an annual fee, and how much does it cost to set up the Home Select loan?
Yes, there is an annual fee, $60 charged directly to the borrower from the servicer, and it's just that covers the banking costs, transactional banking activity throughout the year.
Okay, that's 60, just 60.
Yeah. 60, yes, sir. And then the cost is like any standard refinance that the investor or the borrower would expect. Origination fees, if they apply based on the margin, all the third-party fees that come with financing residential property, it's pretty much the same.
Any last thing that perhaps I should have asked you about with this but did not think about?
Well, I would just maybe offer back to the simulator. For those that are interested in the product, I would have them contact us and we would be happy to take them through the simulator so that they can look side by side in a few different ways. They can compare on a purchase basis this product against a 30-year fixed or even a 15-year fixed if that's what they wanted to do, but that they can also look at it as a refinance and compare against their current mortgage rates and terms and refinancing into something like this. That simulator, I think, really does a lot for helping the individual understand.
We're talking about the Home Select product. It behaves very much like a first lien HELOC. Caeli, what's the best way for a person to find out more?
Yes, they can call us, email us, check our website, toll-free, 855-747-4343. 855-74-RIDGE is the easy way to remember. They can email us at info@ridgelendinggroup.com or, of course, our website, www.ridgelendinggroup.com.
Caeli Ridge, this has been a very exciting, flexible product that helps increase one's liquidity and reduce the amount of interest that they pay over time. Thanks so much for coming back onto the show.
It's my pleasure, Keith. Thanks for having me.
To review what we discussed earlier, the economy is booming based on the GDP anyway, and credit scores are higher. However, the homeownership rate is down. Thanks to Caeli Ridge today, the Home Select loan used in first lien position, it operates similarly to a 30-year HELOC. You can use it on a primary residence up to an 80% loan-to-value ratio or on investment property at 70 to 75% loan-to-value. Your credit limit doesn't start shrinking until after 10 years, at which time you would need to start paying down principal. The advantages of this are flexibility, liquidity, and potentially losing fewer of your dollars to interest over the life of the loan. You could use the proceeds to invest in more income property or whatever else you want, and you could do that sooner. The disadvantage is that if you aren't responsible with your finances, you could turn your equity into fleeting consumer purchases. This can give you quite a bit of liquidity here, at which point you would get to answer the question that a lot of people would just love to be asked. And that question is, what will you do with the extra money? If this sounds interesting to you, at least run your property's numbers through their simulator and compare the mortgage you've got now to how the Home Select loan could be better for you. Start at ridgelendinggroup.com. I'm Keith Weinhold, and I'll be back next week as we discuss 1031 tax-deferred real estate exchanges, how to select your income property market, and a whole lot more. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Countless investors get killed on their long-term maintenance costs in their rental property portfolio, but that's far less likely when you buy brand new construction. Let me tell you about my friends at JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model that allows clients like you to invest in new construction, turnkey rental property. That's why JWB has been featured on the front page of the Wall Street Journal and other national media. If you want new construction rental properties in your portfolio, talk to JWB. Give them a call at 904-677-6777 or visit them at newconstructionturnkey.com. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.